I'm ready to clarify. Yeah. If you have any doubts, you can ask me. I'm ready to clarify for the budget categories because you'll get a definite question that is relevant to the budgets actually. Because flexible budget, cash budget is very important in the examination point of view. So kindly go through it, cash budget, so that you will get a different question on it. Remaining budgets, we have so many budgets are there. Sales budget also there. Purchase budget is also there. These are functional area related budgets. In the functional area budgets, you will not get any huge questions. But cash budget, you will get different question because adjustments they will ask you. They will give you the some kind of information on the amount of cash budget, and basing upon the cash budget, we have to get a additional information also required for that. Basing upon that, we can prepare the cash budget. Okay, cash receipts and cash payments. Just have to consider, and basing upon that, we can prepare the cash budget in a 3 months or a quarter or 6 months or 1 year. That they can have to showcase in the problem level just to go through it. And another important point that I need to discuss the budget aspect. We can have very good important questions from the flexible budget as well as fixed budgets also. But flexible budget, you will get a different question. Just to go through it, that two things also will be there in your material part. Okay. So these are the about budget related information. Just you have to go through the material so that you will get a clear idea about the budget related information. Okay. Next important point that we will discuss about the variance analysis. Variance, we had three types of variances: material, labor, as well as overheads. Variance means actual level of activity and estimated level of activity. We have to compare. For that comparison, we can use the variance analysis. We have a variance like cost variance, sales variance, direct material variance, direct labor variance, as well as overhead variance. That we have very clear idea about in the material. Variance means actual activity and predetermined activity. We have to go with the comparisons. Is there any deviation for that? Is there any things should be happened for that? That we can go with the variance analysis. Okay. So up to this, yeah, do you have any doubts? You can ask me. I'm ready to clarify. We will discuss after your doubts. Okay. Just ask me the doubts so that I can able to answer it, and so that you can able to understand it properly. Okay. Just understand the doubts from the concept side. Like financial accounting, you can ask doubts, or we can ask doubts from the cost accounting also, or maybe management accounting also. I'm ready to clarify you so that we can go with the next further things we need to discuss. I think more doubts in it. Fine. So the next important part that we need to discuss about the variance analysis. Uh, we have material variance, wages variance, overhead variance. There are three important variances. As of now, that material we have a price, quantity. Okay, wages we have a rate and time. Overheads we have volume and efficiency. These are the three important estimated things as per the variance is concerned. Okay, so variance analysis we had a formula based analysis here. Again, we have multiple formulas we need to apply in the variance analysis. So please go through it and have doubts, look on it and let me know. Now, the next important part is called financial statement analysis. So, financial statements are three types: trading account, first one; profit and loss account, second one; third, balance sheet. These are the three kinds of financial statements. Okay, don't confuse if anyone is asking, like, what are the financial statements? Simply, we just answer the answer. There are three kinds of financial statements. One is called trading account, another one is called profit and loss account, and third one is called balance sheet. These are the three kinds. Now, how do you prepare the financial statements analysis? Financial statement analysis we can have to prepare by using an appropriate tools. These tools are helpful to know about exact facts for to making an appropriate financial statements. What are the tools we had? Generally, there are multiple tools that we can have to analyze the financial statements. One, yeah, powerful tool is called trend analysis, common size statement, okay, comparative statement, ratio analysis, and funds flow statement, cash flow statement. These are called the tools. Tools are very much of useful to analyze the financial statements because financial statements are showing like a static in nature. There is no dynamic in nature. If we will not get any the variable related data, it should be always in static. So static financial statements will not give you a adequate picture into the firm. So that it is necessary to add another important analysis tools that may be useful to determine analysis of a financial statements. Right. So the next important thing is called financial statements overlook. We had in a material, it will give you a good analysis and a good overlook on financial statements. Generally, financial statements we can prepare on the amount of vertical statement and horizontal statement. Vertical statement we can prepare should not use any sort of rules and regulations. Directly, there is some procedure will be there so that we can have to identify the procedure. We can prepare the vertical statement. Whereas the horizontal statement, it is a rule based. Suppose as of now that we discussed earlier, nominal account rule. What is the rule for the nominal account? All expenses and losses and credit all gains and incomes. Expenses and losses should be recorded into the debit side. Gains and income should be recorded into the credit side. That rule we can follow and that rule we can apply as per the analysis. So at the end of the day, we have to prepare the statements. These statements are static in nature. So that we can have to convert the dynamic in nature. That's the reason. Okay. A ratio is a mathematical expression which shows the relationship between two interrelated variables. Generally, ratios are of the firm. So here, what happened? We can have to apply different numerical formulas to find out the best quick ratio will be there. Absolute liquidity ratio also will be there. These are called short-term ratios. Will define how the firm is able to meet the current obligations. And long-term ratios like more than period of the 1 year time, like we had uh, the long-term ratios like the solvency ratio, okay, as well as debt equity ratio. We had a long-term ratios what we had. Both the current ratios are the short-term ratios and long-term ratios are very much of important to decide the company financial performance. Sometimes we can have to identify ratio analysis by using EV8 and EPS analysis. That is also very much of important as per the subject matter is concerned. Okay, so you'll get a definite question on it. What is ratio analysis and what are the classifications of ratios? Okay, long-term ratio and short-term ratio are the major classifications. Basing upon that, we can add many number of ratios. Even profitability ratios also we can calculate. Let us take an example: gross profit ratio. Gross profit divided by net sales into 100. Suppose if you want to calculate net sales, suppose net profit ratio, net sales divided by, sorry, uh, net profit divided by net sales into 100. That is the easiest way method what we need to calculate in the profitability ratios. What is the ideal for the ratios? Generally, expenditure ratio should be less. Okay, current ratio should be 2 is to 1. Quick ratio should be 1 is to 1. Absolute liquidity ratio should be zero point 0.5. It depends upon the firm size and firm decisions. We can have to prepare the ratio analysis. Ratio is simply nothing but it is a mathematical expression that should have to understand in initial level. Okay, and the ratios are very much of useful for financial statement analysis. Suppose a company wants to go with analysis part in detail. In that scenario, it is necessary to prepare all the requisite ratios so that we can have able to understand the ratio part. Okay, so just to have a look on it, we'll take 5 minutes of break for this session. Later, we will continue the topic in MMPC 4. So, have any doubts? Just ask me. I'm ready to clarify. Okay, fine. Okay, now welcome back to the session again. Just to have a overlook on it, like different kinds of ratios, what we have, like current ratio, quick ratio, absolute liquidity ratio, profitability ratios. Also, we had like gross profit, net profit. Okay, and as well as operating ratios. We have to discuss like administrative ratio, selling ratio, selling distribution expenses ratio. Okay, EBAT, EPS analysis. We had different kinds of ratios. All the ratios are very much of important to predict the firm financial ability. Suppose if the company wants to predict the firm size, firm financial ability, generally it is necessary to apply the ratios. Ratio is a one type of tool, analysis tool. Don't be confusion. Statements are two. The statements are three. That is constant. Like trading and profit and loss account and balance sheet. These two are the statements. The analysis are helpful to predict predict the company financial performance. Generally, like suppose a company wants to predict the profitability analysis. For the profitability analysis, what happened? It is necessary to consider about the past data, past 5 years data. Okay. Suppose if you are observe 5 years profit, easily we can find out the ratios because profit we have to incorporate into the ratio. Suppose gross profit you are identified, so net sales you have a value. So gross profit divided by net sales into 100 is called gross profit ratio. What is the percentage of gross profit on the amount of sales volume? Let us take an example. Suppose a company wants to know about the net profit ratio. How do you calculate the net profit ratio? Net profit divided by net sales into 100 again. Okay. Is there any ideal for the profitability ratios? No. If higher amount of profitability indicates, ratio indicates better indication to the firm. That means volume of the profit is more on the amount of sales. Suppose if 100 is a sales, 40 20 percentage as a profit. That means out of 100 worth of sales, 20 is incurred as a profit. That is easy understanding level. We can go with the profitability ratios or ratio analysis. Suppose a company wants to know about the current obligations, whether the company is meeting the current fulfillment or not. That means, let us take an example. A company having current liabilities. Current liability means it is necessary to clear the debts within a period of 1 year. It's called current liability. First example, like a company is procured the raw material from the supplier. Okay. So supplier, what happened? He will allow a credit limit to the company in a certain months and a certain weeks. And basing upon the company brand and goodwill, everything is a considerable element while allowing to the a credit limit to the company. Suppose outsider person wants to justify or wants to judge company is able to pay on time or not. Company is able to pay on time or not. In that scenario, what happened? It is the easiest method is called ratio analysis only. We can easily have to give one ratio to decide the company performance and the company financial activity. That is called activity ratio. Again, we can go with the creditor turnover. Okay, how long the company is able to pay the creditor. Okay, as well as debtor turnover is also one of the important ratio. That thing is mixed with the ratio. Suppose a creditor turnover is indication for firm is able to pay on time or not. Data turnover is an indication for the firm is getting clear debts or not from the outside. That is called data turnover. Suppose a customer is there. Okay, customer is purchased some products from your company Let's take an example. Now, customer is not able to pay 100% of money to you. He will pay only 80% and 90% sometimes. Suppose a retailer is a customer is there. He is only paying 80% of cash at the initial transaction. Later, he promised to pay 20% for the next day or next week. So here, data turnover is an indication for identify whether customer is able to paying or not on time. If he is not paying in on time means what happened? That is not good thing for the company side, and the company may not be agree with the customer terms and conditions. That's the reason ratio is a powerful weapon. We can apply multiple ratios to decide the company financial performance. Okay, and we had one more example like suppose a outsider like a person wants to predict the company balance sheet. Okay, company balance sheet, whether the company is going in a smoother way or not. In that scenario, again, ratio analysis will be helpful. Okay, simply debt and equity ratio will decide appropriate determination of capital of a firm. Debt and equity ratio proportion, how much debt is involving, how much equity is involving, that we can have to another indication for the firm. Generally, what happened, this debt and equity proportion is a useful determination for the capital structure actually. It is not necessary to discuss in the accounting part, but I'm saying some few words about the capital structure. Like some companies will maintain the debt proportion is more, equity proportion is less. Some companies will maintain the debt proportion is less and equity proportion will be more. There is a reverse obligation. Purely depends upon the firm size, like the company, what it is. That is also one of the important kind of nature where we can have to prepare an appropriate capital structure. Suppose a government company is there. Let's take an example. Government companies may not maintain adequate amount of equity capital. They can go with the more amount of debt capital because government company there is no guarantee of the profits. It is a service organization, so that they could not maintain more amount of equity capital. Capital is a formation. That capital formation defines the capital ability of the organization and also the structure of the balance sheet. That's the reason debt and equity should be another important indication for the ratio analysis. Ratio is an application actually that we can apply in a multiple domains, not only for identifying a short-term obligation, that should be applicable for the multiple domains. Okay, that's it. And any more other statements we had? Yes, we have income statement, comparative statement, trend statement. Comparative statement means we have to compare the past year data and present year data, just a comparison by using the ratios. Difference, so we just have to consider, and basing upon the difference, base year I have to consider, and the change element I have to consider, so that it is easy to compare from the past to current year. Let us take an example. Last year sales is 1 lakh. This year sales is 1 lakh 20,000. So what is the comparison here? The 1 lakh sales increased to 1 lakh 20,000 and the change is 20,000. That means it's a 20 percentage of the base year. That is easy to compare. That we can consider as a comparative statement. And another important statement that we can generally use in the financial statement analysis is called common sense statement. In the common sense statement, what happened? Say, generally, sales value we can have to consider as 100 percentage. For 100 percentage of sales, what is the remaining percentages we have to calculate? That is called common size. Let's take an example. Gross profit is 20 percentage on the sales volume. So the value just have to convert into the percentages. Okay. Gross profit is let us take an example on 1 lakh amount of sales. The gross profit is 20,000. That means 1 lakh sales is 20,000 gross profit means the sales will be 80 percentage and 20 is included as a gross profit. That we can have to understand as a common sense statement. Common sense statement is nothing but it is a comparison statement, similar kind of comparison, but volume of sales will be considered as are treated as 100 percentage. The sales is a basic origin for common sense statement. Basing upon the sales, we can have to justify the remaining volumes. Like administrative expenditure, what is the percentage of administrative expenditure on the amount of sales? That we can have to calculate. Selling expenditure, what is the selling expenditure on the amount of sales? That we have to calculate. So all the expenditures, all the revenues will be calculated on the amount of the sales. Okay, sales should always be 100 percentage and remaining part should be changed according to the nature of the activity. Suppose the nature of the activity will be increases, automatically sales volume we have to deduct. Okay, that we can go with the common sense statement. And trend analysis, what is trend analysis? We can okay, we have a bar diagrams, right? Bar diagrams, increasing or decreasing of bar diagram, sales volume of bar. Suppose last year is 1 lakh, this year is 1 lakh 20,000, and next year there is a chance of 1 lakh 30,000. Now we can have to showcase the bar. 1 lakh is a one bar, 1 lakh 20 is another bar, 1 lakh 30 is another bar. It is showing an increasing trend. Suppose there is a chance of decrease. Suppose let us take an example. Last year is 1 lakh, this year is 1.2, next year is 90,000 sales. Now it is a decreasing trend, so that you can easily identify by using a bar diagram. Bar or pie charts, line diagrams is a very good examples as per the trend analysis is concerned. Trend means a statistical, okay, information should be provided to the audience, okay, by using a graphical representation of data is called trend analysis. What, how do you prepare the graphical representation? By adopting the methods like by adopting the methods like the various activities that we can go with the trend analysis. Both the trend analysis, common sense statement, comparative statement, these are called analysis tools. Mind it the point. Very clear. Okay. Just I'm giving the overlook on it. Just to go through the material. Again, I'm saying just to go through the material so that you will get a clear information about this one. Because I'm explaining more means you will get a more confusion on it. So next important point is called understanding of annual reports. Annual reports are nothing but three important reports we can have to prepare: balance sheet and profit and loss account and cash flow statements. Why we need to prepare the balance sheet? Balance sheet is a exact information to get the financial status or the financial results of the firm. And a profit and loss account, why we need to prepare? Generally, it is necessary to predict lesser information about the profit or loss of the firm. That's why we can prepare the profit and loss account. And there is a mandatory report that we can have to showcase. That report is called cash flow statement. Earlier, cash flow statement is not important one, but later days, what happened? Cash flow statement is necessary to prepare all the financial institutions or manufacturing units. So balance sheet, we had the representation of liabilities and assets. So what are the liabilities we had? Current liability, long-term liability that we have to insert there, and as well as assets, we can have to insert like current assets, fixed assets, long-term assets that we have to insert into the asset side. So balance sheet is always balance that we need to remember always, and as well as cash flow statement also we need to prepare into the financial statement analysis or financial statement trending activity. What is cash flow? Cash flow is nothing but the cash inflow and outflow of funds. Generally, cash flow means cash inflow. What happened? How the cash is coming in the organization, and outflow where we can apply the where we can have to apply the cash outlay. That we two things have to elementary things that we need to observe as per the cash flow statement. Okay, cash flow and funds. Cash flow is necessary to prepare. Funds flow is not necessary to prepare because funds flow means it is a another important statistical tool, financial tool that we have to judge the analysis of the firm. Fund is a working capital, flow is a movement. The corresponding working capital change is nothing but funds flow statement analysis. So it is not a necessary statement. Cash flow is a necessary statement that we have to exhibit, but funds flow is not necessary. So funds flow we can have to showcase into the analysis part, not in the statement information, because statements we should not be represent as the funds flow statement. Okay, so both the financial statements are very much of useful as per the form aspect is concerned. Right. So I think you are able to following my class. Just go through it. I think she's left. So I will continue the another session. Kindly wait.